are.
Well, well, I feel like I am. Goodness.
Okay, we are live. Now, if maybe we want to wait just another minute or two, and maybe some other folks will jump in.
Wow. 1, 2, 3.
Well, we do have 4. If we want to go ahead and get started.
Okay. Martel, you ready?
Yes, hey everyone, I call to order this meeting for the investment committee on August 18th, 2022 at 4:33 p.m.
I'll do a roll call. Angela Banks.
Here.
Christina Bennett. Lewis Cross.
Present.
Sheila Goodwin. Donna Jones. Yvette Levy. Martel Mann.
Here.
Bobby Richardson. Albert Sanders. Justin Stein. Doris Walker.
Here.
Okay, so again, we have 4, so we do have enough for a quorum. So Gwelda and Jeff, I guess the floor is yours. You want to start with the quarterly report or the monthly, or?
I'll start with the quarterly, albeit this information is old. Because we're more than halfway through the third quarter. So I'm not going to belabor this too long and let Jeff bring you some good news for July. But if you'll turn to page 3, let me go to the next page. I think there's the Greenwich studies in here. I'll go to the next page. Let's go. No, we'll start with the economy. Okay, we'll start with the economy. So I'll just hit some highlights on the economy. As you all know, inflation continued to be top of mind. Slowing down in growth in the markets, which have been very volatile, as you all know, in the second quarter of the year. The Fed raised interest rates twice and to total about 1.25%. The increases were to try to arrest inflation, which we're all seeing everywhere. We actually have seen energy prices drop a little, but food prices and things are still high. The one thing that's keeping the government from calling this a recession, is the labor market, which continues to be strong, and it's actually back to pre-pandemic levels. So labor market is still strong, but the other things that would say we're in a recession are in play. In the U.S. equity markets down here on this page, As you know, they were down across every capitalization, small, mid, and large. And they're both negative in growth and value, albeit value, as you'll see in the upcoming pages, was down less than the growth markets. Mid-cap growth was the worst performing style. If you look at the international markets, also struggle with the EFA index down negative 14.5% and emerging markets down 11.4%. If you look at the fixed income markets, concern over inflation and rising interest rates, interest rates went up, so bond values go down. As you know, those move inversely. So the bond markets were down broadly, with treasuries being the least negative out of the group. Turn to the next page. So as I mentioned on the prior page, you can see here at the top, you see all of the equity markets across the board at the top, going from the MSCI emerging markets up, were all negative in the second quarter of the year. And if you look down to the green or light green, dark green and the light green bars a little bit below, you'll see that fixed income, as I mentioned, were also negative. The T-bill, as you can see, that was just slightly positive at 0.1%. So not good news this quarter, although, you know, we had a very, very strong market last year, but we're seeing some corrections from the first quarter and the second quarter. We're starting to see some turnarounds, as you can see you'll see in the month of July, as well as in August. We've seen some positive things in the month of August as well. Down here also, if you look at the lower part of this page on the right, you see this is the 1-year performance. Because of the weak returns in the equity markets in the last couple of quarters, they have brought down the 1-year numbers across the board for domestic as well as international markets, as well as fixed income. You turn to the next page. This is an illustration of what I told you regarding style. As you can see here at the top, the blue bars represent value. The gray is core, which is a combination of growth and value, and the green bars represent growth. As you all know, growth had a very, very long run and a very, very strong run for several years. But as you can see here, it's reversed. As you can see here, albeit negative, the values value indices are actually less negative than the growth indices. And if you look at the bottom, you can see it's even more pronounced here in the 1-year performance. For instance, look at the Russell 3000 value here, a negative 7.5. But you look at the Russell 3000 growth is a negative 19.8%, which is more than double negative in the growth market. So we're seeing a strong reversal in style performance for the equity markets. Let me turn to the next page. You look at economic sectors, as you can see here in the top, the defensive sectors that actually delivered positive performance in the large cap area were consumer staples with a positive 5.3%. Energy, which should be no surprise, in the quarter delivered 40%, excuse me, and healthcare was slightly positive 0.4. Over the 1 year, the only economic sectors that actually show, utilities, 13.4. Over the 1 year, the most defensive sectors, energy and utilities, were the two segments of the economy that actually eked out positive returns on a 1-year basis, with energy at 20.5 and utilities at 7.8. Turn to the next page. Keep going, one more page. Okay, fixed income. So we've already talked about domestic fixed income a bit with respect to the performance of treasuries versus other types of bonds in the domestic markets. But if you look here, just like in the domestic markets, global fixed income was down across the board. You're looking at negative numbers in the dark blue is the US equivalent, and the local currency of that particular different countries is a lighter color. But the most important thing to look at here is you had negative numbers. So there was no place to hide, either domestically or internationally in the global fixed markets. You will see a slight bit of positive numbers when we start looking at the actual performance of the fund. You'll see one segment that actually fared well and is also an inflation tool. Any questions on the general market before we go into actual discussion of the fund itself? Okay, if you can move.
I have one question.
Sure.
Hi, everybody.
Hi, Bobby.
Hi. So my question is, why is the dark blue, the US negative, higher than the local currency?
It's the currency effect, the dollar value, the valuation of the dollar compared to local currency. You start looking at those currency conversion rates. The US dollar was strong, so it hurt the returns. Like if you look at them in dollar terms compared to the local currency.
And the way that works, Bobby, is just to sort of think about it. So when we go out and invest in the international markets, we have to buy a different currency. So we have to go out and buy euros and then buy those stocks. And then as a US dollar-based investor, eventually we have to bring that money back and convert it back to dollars when we do all our accounting and everything else to base it in dollars. So when the dollar is strong like it has been, and that generally happens in markets when the US is raising interest rates and the rest of the world is not, then the dollar tends to follow that. So we've had a very strong dollar. And so what happens now is the dollar has gone up, and when we come back, we can buy less dollars, and that kind of works inversely, and that cuts into our return. So that's sort of how that works and why we show it that way. And you'll see that inverse in periods when the dollar is weaker. So that's actually better for a dollar-based investor. So if the value of the dollar goes down relative to everybody else's currencies, when we bring the dollars back and we're buying more, we can actually buy more of them because the dollar is cheaper. So it's sort of an inverse relationship.
Okay, thank you.
Any other questions? No? Okay. If you move forward to, I believe it's page, keep going. I'm trying to keep going forward. Okay, this is where I want to start. Okay. The asset allocation of the fund, as you can see, the inverted black triangles, as we've discussed in the past, is where those segments are actually allocated in the fund. As you can see here, most of them are within the range. The range is the gray bar, which is the upper and lower range that we have established for each of the asset classes. You will see that here you've got some off target and large cap international are the ones that are most off with, and also real estate and the total hedge fund is out. But what I would remind you of here is that we are in the process of rebalancing. So these are going to be a little bit out of whack until we finish all the rebalancing, which we're in the process of doing now. So these will come back together like they should, closer to that little black line in the middle, which is a target as we move forward and finish the rebalancing that was recommended and approved, recommended by us and approved by the committee in past meetings. If you'll move forward to the next page. As you can see here, this is the market value of the fund as of March 31st compared to now. And as you can see here, the market value did decrease. At the end of March, the market value was $906,357,387. And as of June, due to the depreciation of assets in the marketplace, it's down to $809,403,381. You'll see this number come back up when Jeff does the update through July. The next page in the report are the fees. These are the fees as we show in every report of all your managers. So you can see on a annual basis, estimated annual fee. And then these calculations are done off of the market value as of June 30. So you can see what the approximate fee is on an annual basis. So it's basically 1/4 of that amount for each quarter for each of your managers. The next page should be the next couple. Okay, there's some more fees with respect to your real estate managers and your managers in Westville. You don't have the private markets in this fee table here. This is for the estimated annual fee excluding privates is about $3.7 million a year. Okay, we're monitoring the brokerage. As you can see here, we have added in some of the managers that have not been reporting in the past, which are Intech and TCW. The rest of all the managers here, with the exception of TCW and Intech, have all met their goal as stated in your investment policy document for trading with minority, women-owned, disabled business enterprises. TCW and Intech, as you can see, Intech does have 14% allocated as year-to-date towards MWDVE brokerage firms. TCW, we had conversations with them and they have brought on some minority brokers. So that number should improve. And as we stated in our last meeting with you, they've asked that we evaluate them at the end of 2022 to give them time to get up to speed with us trading. So the numbers are low here, but we expect to see that number increase over the next couple of quarter reporting. You can move forward to pages. This is the reconciliation, and if you'll move to the next page, Sue, there, the total at the bottom. As you can see here, this basically is the cash flows of the fund during the second quarter of the year. You see the ending market value as of the beginning of the quarter there. You see contributions of about $6.4 million, distributions of $26.7 million, management fees of $186,557, other expenses of $62,415. Not a good thing here, but the capital loss of $76,406,240 to bring you down to your ending market value at $809,403,381. So you can see clearly on a quarterly basis how the cash flows are going. You will see that number, market value, as I said, go up because we did see some capital gains in July. Any questions regarding the overall picture before we go into the actual performance of the fund in the second quarter? If not, if you would move forward. Keep going. We'll go past the reconciliation. I think it's page 17. Okay, here we are. Go back one page. Okay, so this is where we compare the St. Louis Public School performance, the total fund performance versus other public funds that are slightly below, that are below $1 billion. As you can see here, the ranking is competitive in the quarter, albeit negative. You had a negative 8.48. Versus other public funds, you have done better than the median, ranking 18th. As you can see, the median there is a negative 10.23. So the fund, if you look at you versus other public funds, you're ahead. The year-to-date number is also competitive. You're ranking 24th, 1 year, 33rd, 2 years, 30th. Longer term, not as compelling in the 3, 5, and 10 year, but since inception, the number is better than the average public fund of less than $1 billion, ranking 40th with a return of 6.63 versus 6.11. So these rankings are coming up. I know this was something that we looked at when we first came on board, but the numbers are actually coming up compared to other funds. You can move forward, Sue. Move forward to the next page where we get into the actual performance. Okay, this is where we'll get into the actual returns. I know you see a lot of negatives on this page, and you'll see a lot of negatives on a lot of the pages. So it's all relative performance. So when we're looking at situations like this, negative is negative. I mean, it's not good, but what you want to see in markets like these is for your active managers that you're paying fees to, not the index funds. Index funds are just going to be whatever the index is. But what you want to see is your active managers protecting you on the downside and are less negative. So this is when active managers can say, okay, we're fishing in a bad situation, but we're going to try to protect you as much as possible. So I'd like you to focus in on that as we go through this, but it's not a good quarter. I'm not going to sugarcoat it at all. But your managers, a lot of them have actually held up versus their respective benchmarks, as well as versus their peer group. The first active manager on this page is Edgar Lomax. They're a large cap value manager. You see them at the bottom of this page. The index returned a negative 12.12 if you were to just have indexed that. Edgar Lomax actually was less negative, it's negative 7.71. Their defensive nature, they're a large cap value manager, very conservative. As you can see here, that return ranked them 7th, which is in the top quartile when you look at other large cap value managers. On the fiscal year to date basis, they also are ranking well and have outperformed the Russell 1000 value. And if you look across the page on here, actually Edgar Lomax has beat the Russell 1000 value in all time periods measured as of June 30. 7.49 for 3 year, 9.06 for 5 year, 11.2 for 10 year, and since inception, which was back in 1996, they have delivered outperformance versus the Russell 1000 value index. So in a very tough market, they have protected you on the downside. Go forward. On this page, you'll see you've got at the top your 2 large cap active growth managers, Intech and TCW. As I mentioned earlier in the broad market discussion, I mentioned that growth was very, very difficult and a hard index. There was the most negative indices in this past period. As you can see here, both Intech and TCW actually in a negative, very negative market. They Intech actually added value in that they weren't quite as negative as the Russell 1000 growth. The longer term numbers are more challenged. They're just below median for the quarter. But Intech does have some issues long term because the since inception number, as you can see here, is below the Russell 1000 growth. Plus, we also have some issues with respect to their brokerage policies. TCW is a manager that's going to be coming into the September meeting. On a relative basis, they actually underperformed and they did not rank well versus their peer group. So we're going to be interested to see what their discussion is at the next meeting in September. But the large cap growth managers had a really tough time, and TCW actually didn't hold up as well as Intech in the second quarter of the year. As we move down capitalization, we're looking at small cap growth, small cap value, and a micro cap manager. Actually, these managers, if you look at all 3 of them, Westfield representing small cap growth on a relative basis, they did better than the Russell 2000 growth with a negative 17.72, less negative than the Russell 2000 growth at 19.25. And if you look at their ranking in the little parentheses, on a relative basis, they have outperformed their peer group in all periods, the median of their peer group in all periods, with the exception of the since inception number. And they've delivered outperformance versus the benchmark in all periods measured with a since inception number of 8.94 versus the index return of 5.44. Systematic is your small cap value manager. And as you can see here, they held up in a difficult market. This is a value, so you'll see the numbers are a little bit less negative, but a negative 11.55, ranking 28th. And if you look across the board here, Intech has outperformed their benchmark, the Russell 2000 value in all time periods measured. They have had a little bit of a hiccup in the fiscal year to date in the 1 year versus in their peer group. But if you look at the long-term number, not only have they outperformed the Russell 2000 value, but they rank 21st in the upper half versus their peers. So they're doing better than the average manager since that inception date of October 1 of 1999. DFA is your microcap manager. As you can see here, This is another example of protection on the downside. They've done better than their benchmark and significantly better than their peer group, ranking 7th in the current quarter. If you look across the board, fiscal year to date, 1 year, 5 year, 10 year, and 10 year, they have outperformed the index in all periods. And the only period where they're showing where they're below the median is in the 3-year number versus their peer group. Now we move down to internet. Yes.
Question. It looks like both of the large cap growth managers are not performing well long-term.
Right.
That you mentioned TCW is coming in.
Yes.
But what about Intech? And I guess when you had the slide up about the fees, I know there was some discussion at one point in one of the meetings about fees. I guess I'm just wondering, the fees that we're paying them basically for not good performance on a long-term basis.
That's something that Jeff and I have discussed, and Jeff, please weigh in if you'd like. We've discussed regarding that particular segment. We are going to evaluate whether or not we want to stay in active management. Actually, the underperformance along with the brokerage for Intech, there's been discussion of possibly either indexing that portfolio or rolling it into TCW. But that's a discussion that we have not come to a conclusion on. We'd like to see what TCW has to say about their performance. And we'd like to also see what they're going to do with brokerage. So that's kind of up in the air until we come to a definitive decision on whether we're just going to index that section or if we're going to keep one active manager and index the other. Jeff, did you want to add to that?
No, that about sums it up. And I think just from the internal research that we've done, and again, I think we all know some of the issues that we faced with Intech in that, number one, there's certainly the diverse brokerage issue that is probably just, they're just not going to meet those minimums based on discussions that we've had with them. Number two, they've had some organizational issues, and certainly as you all have pointed out too, the performance hasn't been great. And as we look at the strategy, it's one of those that from a performance perspective, it's not underperforming by a ton, but based on what they really do, it's almost an index plus type strategy. So they're almost diversified and risk controlled to the extent that they look like an index, and then they're doing other things actively on the margins to try to add a little value. Well, they haven't done it, and also it does come at that higher fee relative to an index. So as Gwilda said, we've evaluated a couple of paths, and the first is there another large cap growth manager that would be complementary to TCW? And we went back to our research team and said, okay, here's who we have in the mix, and here's some of the things we're looking for. We're looking, we like to prioritize a diverse mandate. We like to prioritize, secondarily, if it's not a diverse mandate, at least someone that can meet the diverse brokerage mandate. And what do we have in the stable of things that just look good or consistent performers, as Gwilda has talked about, has that good characteristic of protecting on the downside in these crazy markets. And our research team came back and said, we really don't have anything right now that sort of stands out and looks spectacular. So the second path was, well, let's just look at indexing that piece for now, because it's very low cost. It gets us the exposure we want. And then the third path, that would be, similar to what we're doing on the value side, where we have one value manager, and Edgar Lomax, they've done good, a good long-term manager. So, could we feasibly have one manager? We could, should that manager be TCW? And as Gwilda said, that's sort of what we're evaluating now. Let's have them in, hear what they have to say, number one. Number two, certainly they're just getting on board now with the diverse brokerage, and we want to make sure, all indication they've given us is that they're going to be able to meet the minimums, but we do need a couple of quarters just to see how that is playing out. So I think it'd be sort of premature to say, let's make TCW our only manager. So I guess we can think about it and ask the committee to think about timing. I mean, from our standpoint, you know, we certainly think there's been enough issues with Intech, and we've had them on watch and had the discussions that we could certainly come back to the table at the next meeting or the next couple of meetings and think about timing and say, this is what we want to do as an interim step. But I would say if everybody at this point says, well, we've really had it with Intech, then probably the most logical step at this point would be to think about a way to index that. But I think at this point, we wouldn't want to pull all that money out of Intech and put it into TCW. And then again, for a search for a different active manager, at this point, we're just not seeing one that makes a whole lot of sense.
Okay, thank you. That's what I was thinking, indexing.
Okay.
Okay. Moving down the page, we're looking at the international developed markets, and you see the two managers there, Fidelity and Causeway. Fidelity is an international growth manager, Causeway international value. As you can see, both of those managers on a relative basis have outperformed the MSCI EAFE with respect to their value style. Fidelity ranks well versus other international growth managers, and Causeway has done well relative to other international value managers. If you look across the page, Fidelity has had a tough period in the 1 year period, but if you look at the 3 year period, the 5 year period, the 10-year period, and since inception, they have done well versus MSCI EAFE. They have not performed quite as well versus their peers and versus other international growth managers. If you look at Causeway, which is your international value manager, which is the last one on the page, on a relative basis, Causeway has outperformed the MSCI EAFE for the quarter, the fiscal year to date, the 1 year number, the 3 year number, the 5 year number, the 10-year number, and since inception. They have had better relative performance versus their peers and are ranking either above median or just slightly below median in those periods. So the fact that you have basically have style neutrality. I mean, style neutrality means you have a balance of growth and value in your different segments that helps smooth out the returns. For instance, if you only had international growth manager, your international segment would look really not good. As you can see here, the international segment was a negative 11.71 versus a negative 14.45. So that was helped by you having a balance of growth and value managers in their international space. Moving to the next page, this is your emerging markets. At the top of the page, you have DFA and Invesco. DFA fared better than Invesco, but both of them outperformed the emerging markets index in the second quarter, both ranking above the median of their respective peer groups. As you can see here for DFA on a long-term basis compared to the emerging markets index has actually outperformed in every time period measured. They're competitive versus their peers with the exception of the since inception date. Invesco emerging markets has not done quite as well versus their peer groups nor versus the benchmark. So that's a management that we will want to watch going forward. The DFA value style has been additive and helped out in that emerging markets equity space. Exponence is your manager of managers in the global space. As you can see here, the roll up there, they actually helped on the downside with a negative 14.36, and the ranking there is above median at 42nd. And a since inception number that just came on in 2020, they're above the MSCI World with a return of 4.47 versus 3.52, and they rank above the median at 49th. That should round out the emerging managers. If you go on page 20, the next page 29, this is fixed income. At the top of the page, you've got the roll up of fixed income. Tough time for fixed income. We talked about Rising interest rates, which work inversely, and it hurts the values of fixed income portfolios. As you can see here in the core fixed income, you've got Manulife, Ernest Partners, and Exponence. If you can see here, out of these three managers, the manager that held with the best and actually delivered less negative numbers was Ernest Partners, with a return of negative 4.28 versus a negative 4.69 for the Bloomberg aggregate. That return ranked them 18th, significantly above the median manager. As you can see, Manulife and both Exponence had a very difficult quarter. Both of them underperformed the Bloomberg aggregate and ranked at the bottom quartile. On a long-term basis, Manulife, you look at since inception with some hiccups in between, they have actually done well on a long-term basis since inception at 6.45 versus 5.61 and rank at the top of their universe at second. Ernest Partners, with the exception of a couple of time periods, a 3-year and a 5-year rolling and a 10-year, but their since inception number is competitive. They've outperformed the Bloomberg aggregate and ranked 49th versus their peers. Exponence has had up and down, but as you know, that is a different kind of portfolio. The numbers here don't look good if you look at the rolling periods here. The since inception number, though, actually ranks 22nd at 1.76. We're continuing to monitor that portfolio. As you know, we did have a portfolio manager change. So it's something Jeff and I will continue to look at and assess going forward with Exponence. Your absolute return manager, Loomis Sayles here, did not do well versus the 3-month plus the LIBOR. But if you look at them versus other managers, other global managers, you can see for the quarter, they actually ranked 34th, fiscal year to date and year to date. 1-year numbers are actually above median. The long-term numbers are slightly below the median, ranking 55th. The TIPS is the next section. That's an index fund. And as you can see here, the TIPS is just all it does is mimic the TIP index, and it ranks right around median of the median TIPS in the peer group. Go to the next page. Your global multi-sector manager, Neuberger Berman, did not fare well versus its benchmark, but if you look at them versus other global fixed income managers, they actually outperform with a negative 6.67, and so they did better and ranked 43rd. And if you look at that fiscal year to date number, they're actually still above. The 1-year number, 3-year number, not as strong. And that long-term number, this is a manager, as you will notice in the back, when we get to that section, they're actually qualified for watch. And that since inception number is not strong at all with a 0.66 return and a ranking of 73rd. Then you've got Lazard in emerging market debt. They had a really tough time and did not perform well versus the index, nor versus the emerging markets emerging markets manager. The ranking for the 1-year number and the 3-year number is strong versus the index, as well as, the 1-year number is not strong versus the index, but it is strong versus their peer group. The 3-year number is strong versus both. The long-term number is not as compelling. The since inception number since 2016, they're below their benchmark and they're ranking at the bottom of the scale versus the median manager in their peer group. We have 2 global TAA manager, global asset allocation managers, You've got GMO and PIMCO. As you remember from the discussions before, we are liquidating the GMO portfolio. They did actually deliver this quarter with a less negative return than their benchmark, and they ranked above median. But if you look at the long-term numbers for GMO, the rationale for us terminating them, as you can see, the long-term numbers are not strong versus the index nor versus their peer group. Now, PIMCO actually had a difficult quarter. They did not fare well versus their benchmark, but they're right around median for their peer group. If you look at the longer term numbers for PIMCO, as you can see, they have outperformed their benchmark. and it had mixed performance versus their peer group as far as their ranking. The 1 year, 3 year, and 5 year numbers are strong versus the peers. The 10 year since inception, not as compelling, but they're above their benchmark. In the hedge fund space, actually, all of your hedge fund managers, Entrust, Whitebox, as well as Grosvenor, all outperform, with Entrust having the strongest performance versus the HRFI Fund of Funds Index. You see here they're slightly negative, a negative 0.52 compared to the index, that index at negative 3.88. If you look at Entrust, long-term Entrust, with the exception of that, this current period, they actually are having a little difficulty on the longer term, but still better than longer term. They're still having some difficulty versus the composite index. If you go down, you see Whitebox there. Whitebox is actually probably your strongest performer here. They have protected on the downside, and they have actually outperformed for every time period measured versus the multi-strat index. Grosvenor, you see that Grosvenor has protected on the downside this quarter with a slightly better return. The fiscal year-to-date numbers, you know, a couple quarters ago, we had some more difficulty with Grosvenor, but if you look at the longer term, 1 year, 3 year, 5 year, 10, 5 year, and since inception, they haven't been here 10 years. Since inception, they have delivered value over and above their composite index that they're compared to. If you go to the next page, these are your real estate managers. As I mentioned earlier in my discussion, here's some positives. And this is your inflation hedge. You've got, even though we're having some the Trumbull funds are having some, had some performance challenges, that actually delivered positive numbers for the quarter. As you can see here, you got a positive 4.03, not as strong as the index they're compared to, but it is positive. Slightly below the median. The fiscal year to date is ranking 49th. The longer term returns that we've discussed, Trumbull has had some difficulties. It's a very conservative fund and has not ranked well versus their peer group. But if you look since inception, albeit not as great as some of their peers because of their conservative stance, they have delivered a return of 7.5 positive in the since they were hired in 2004. The same thing falls for the property income fund, not as strong versus their peer groups, but they have delivered positive returns. And actually here in the since inception number for this, the second fund, they've actually outperformed the Odyssey at 8.7 versus 7.03. And that rounds out the fixed income managers. We have not, as you can see down here, you can see there are a lot of the privates have not reported for the second quarter, so we don't have updated returns for those managers for the quarter. Any questions before we go back to the back? I want to give you, talk to you about the watch list. I believe that's page 84. So, okay. The changes here from last time, as you can see here, Edgar Lomax was on the recommended for watch list the last time. And if you've noticed, Edgar Lomax has been bringing their returns up over time. So per the investment policy, it is showing them to come off watch. As you can see, they pass in all the criteria, so they're not recommended for watch. Intech and TCW, no change here. That's the same as it was last time. Systematic stays the same. It has not changed. The Invesco Emerging Markets still is not faring well, so it's still recommended for watch. The Neuberger Berman is new. Neuberger Berman was not on the list the last time, but they have failed some of the criteria, so they do qualify for watch. And we'd already talked about GMO, and we had recommended liquidation to help meet some of the cash needs and moving, just having PIMCO all asset in that particular part of the portfolio. Any questions on second quarter report or anything that I've discussed with you regarding the manager performance in the second quarter? Okay. If not, I'm going to turn it over to Jeff and let him bring you up to date and give you some better numbers. He's got the good news tonight, not me.
Thanks,
good.
Barbara.
You're welcome.
Yeah, Gwelda had the double the double negative. She had the tougher numbers and the longer report, so she lost the coin toss.
Yeah.
So Sue, if you want to flip over a couple of pages, I think we'll skip over just the little market overview page because we'll hit on some of those highlights when talking about some of the managers. So if we just want to go right to the allocation page. Great. So here's the allocation page. And the one thing that I did want to point out is that this will now reflect the new target allocations and ranges that were recently approved and as we recommended. So this is now reflective of that. And again, probably not too dissimilar from what you saw in the quarterly report. We do have some deviations, but as Gwelda had discussed, that those will move closer to those targets within that middle line as we complete and finish up rebalancing. But again, just to discuss how all of this works relative to policy, each of those gray areas is an allowable range within the policy. So if we're within that, we're still fine, and that's by design and why we have the ranges and why you see the bars that are a little bit different with ranges. There is a methodology behind that. And number one is asset classes that tend to be a little bit more volatile will have the larger range to allow to capture some of the movement that we might see on an ongoing basis. But but small cap, you say, hey, well, why isn't that range as large? Well, we also size the range on something like small cap to say, we do want to limit the level of volatility we do allow in the portfolio. So let's tighten up that range and look to that to rebalance a little bit more strictly in certain times. But again, it just so happens that those areas of the market, which tend to be a little bit more volatile, like small cap, international, emerging market equity, we're pretty close to our targets on those. So it's the large cap equity. And again, that one gets rebalanced. As you recall, we approved putting more money over towards the index portion within the portfolio. So as that happens, we get closer to that to that range there. So and then the global multi-sector is a little bit towards the upper end of that range, but again, that's a lot of that's going to be really due to again classification. Some of that's going to get rebalanced over time, and then what happens invariably with all of these asset classes is that the markets tend to rebalance us some. So in a market like July, where the equity markets are really good, those triangles in the equity portion start to move up towards their targets, and then the triangles in the fixed income, if fixed income didn't participate as much, those start to go downward. So there's a little bit of that mechanism that comes into play as well. The hedge fund, and that's the one that probably sticks out the most because it is red technically outside of that, but we again, by policy, if we see this at any given quarter, we need to make actions towards getting that rebalanced, and that is part of that overall rebalancing plan that we had recommended over the past couple of quarters. So we are scheduled to have a redemption from Grosvenor, and as we do that, that level will bring that hedge fund target within where we want to be. So again, all things considered with how we've restructured and where the new percentages and new ranges are, everything is in really good shape. And again, we already presented a plan that's in motion that gets us closer to all of those targets. And again, as we discussed at a more 30,000 foot level, when we went through all of those recommendations, all of this designed to really to tighten up a lot of the risk controls and factors that we had in the plan and really maximize that overall risk reward in the portfolio. And again, Sue, if you want to flip forward, we can take a look at some returns. not 1 month does a history make, but certainly it was a good month in July, and we got a good portion back, and a lot of that really coming from the equity markets. But I really point to the fiscal year to date period as well, a little bit below the benchmark. And again, it's not going to be too much of a deviation from what you saw in the quarterly numbers and what Gwilda talked about. But again, starting to tighten that gap in the 1 year period, you see that as well, that we're actually better than the benchmark. It's still negative, but again, the objective here is we want to minimize all of these risks. And whenever we're looking at ourselves versus a benchmark, we want to be at or better than the benchmark. And as Gwilda talked about as well, we want to be at or better than medians in comparable universes. So that's really the end term goal. And then certainly we have actuarial returns and assumptions that we have to meet. And again, if you go out to that 10-year period, we're just above 7%. And frankly, if we look at this portfolio and the structure and what we would expect over time and the risks that we are taking on and the risks that we're avoiding, that's about the type of return we would expect for this portfolio. So over a longer time period, somewhere in the neighborhood of 7 to 7.5, maybe 8%. But again, if we went back a couple of quarters before the market started to turn down and those 5 and 10 year numbers were double digit, they looked really good. But we always wanted to caution everybody to say we're not saying this is a double digit portfolio, because longer term it really is not, and it's designed to do what we're going back and forth and talking with actuaries about, and coming up with that number that makes all of their numbers and all of their math work. So this is a portfolio, again, as we showed you, that is designed to do that. So but again, a really good month. August, and Gwilda talked about this as well before, is off to a good start. So a little more than halfway through the month, the equity markets are up close to another 4%. So that's good, and it goes a long way, again, with a portfolio like this, of chipping away at that negative fiscal year to date return and moving us in the right direction. So we've still have several months left in the year to hopefully get us closer to, knock on wood, maybe being at a positive area before the end of the year. But again, Gwilda talked about a lot of the unknowns and the volatility that still exists in the market, and that inflation figure. And again, if you think about the month, both July and August, and why are we so positive given all of these things that Gwilda talked about, and a lot of these headwinds that we've talked about? Well, a month like July and what we're seeing in August so far is just the market stepping back and saying, well, we now know all of the bad news. It's out there and we've priced it into the markets. And now we've stepped back and started picking through all the rubble and said, hey, there's some things in there that are fairly valued and look like good bargains. And all institutions are saying this, all pension funds like yours, that they don't time the markets and they're not out, but they're all rebalancing on a very strict basis of saying this is a good time to rebalance our portfolio and get back into equities and be at the levels that we want. And so we're seeing a lot of that going on in the markets right now, and that's working out really well. And more recently, I'd say what we've seen from not only the equity markets but fixed income as well is the thought that the Fed might think about slowing down on interest rate increases. So again, I think they've been pretty steadfast in that they do want to raise rates another 0.5% at the next meeting. But after that one, taking a real hard look at the data and seeing how much of a catch up we're going to see on those inflation numbers before thinking about any additional interest rate increases before the end of the year. So there's a pretty large portion of the markets right now that think that this next one could be the last one for a while, and in particular could be a last one followed potentially by a lowering of rates in the fairly short term. If as Gwilda said, the employment number is the big thing that's keeping us out of an overall recession. So if you just go on what the technical definition of recession is, it's back-to-back quarters of gross domestic product contraction. Well, we've had that. So we've now had the 2 quarters in a row. But again, it's that employment number that everyone's looking at that says that's why we're not in recession. So if that number starts to soften and we start to see unemployment picking up, that's where I think the Fed turns around and says, well, maybe we have to be in a position to lower interest rates. And frankly, they're in a position to do that now because of how much they've raised rates. So they've got a lot of tools at their disposal to help get us through the next couple of quarters. And the market likes that. And so that's what we've seen in July and August so far. So as you can see, a couple of reversals, and again, not 1 month does not make a trend, but where growth has been out of favor for relative to value for the past couple of quarters, that has reversed in the month of July. So we saw the growth stocks doing better relative to value. You can see it on this page. Sue, if you want to flip forward one more page. Sort of a similar concept here. Small caps doing very well for the month. So again, that's something we've talked about before. If when you're in recession and then there's thoughts that maybe we can manage our way out of recession, and a certain tone of risk comes back to the markets, or risk taking comes back to the markets, and so everyone looks at those small cap stocks, which is small and mid cap stocks, which have been quite a bit beaten down. And everyone's coming in and buying those as well. So a good month for those stocks. Outside of the US, it's still positive, but a little bit muted relative to the US stocks. And again, a portion of that is going to be due to that currency impact that we talked about. So with the US dollar continuing to be strong relative to other currencies, that's an inverse relationship. And so that cuts into those returns a little bit relative to what we see in the US, but there's also this overhang of things happening outside of the US that are making investors still a little bit more nervous on international stocks relative to the US, and that's the ongoing conflict between Russia and Ukraine, and more recently with China and US tensions with China over their position with Taiwan. And frankly, there's a lot of empire building going on in places outside of the U.S., and it's making a lot of folks nervous. And with respect to the emerging markets, there's a lot of good valuations, and if you look at a lot of the emerging markets that tend to be more based on commodities, and commodities have done extremely well in this type of environment. Again, think of relationships that move together and things that are inverse. So as Gwilda talked about, fixed income and interest rates, that's an inverse. What moves together real nice is commodities with inflation. And so technically a lot of these emerging markets, if there wasn't all of these other political macro events going on, should be doing a lot better. And I think the market recognizes that. We're starting to see investors come back into that market, but they're still sort of tiptoeing. So again, from a diversification standpoint, think about how we positioned. When we came in, we looked at it, that position of emerging markets relative to the entire equity structure was high relative to the full indexed market. And we brought that really in line. So we're really sized along with the over allocation to the market. And so that's good. We want the exposure because it gives us good diversification, and it gives us a long-term prospective return that should be better than where it is today, but it doesn't give us that outsized downside risk. So that's how we positioned. Let's move forward one page. And here's the global equity. So again, the Exponent's doing a fairly good job of getting a nice absolute return. And if you take a look at their fiscal year-to-date numbers, still negative, but in line with the total benchmark. So some mixed results from their sub-advisors, but all in good diversification, keeping them close to the benchmark. But again, this is going to be a portfolio because it's global in nature, does have some US exposure, but has quite a bit of international exposure within the mix. And that's certainly going to be what's bringing those returns down relative to what we see in the US. So it's that international exposure. But again, a good mix of overall diversification within that portfolio. And again, they've had a recent portfolio manager change as well. So that Redwood portfolio, again, not 1 month is not always the best indicator, but it's good to see having that new sub-advisor off to a good start at almost a 10% return relative to a benchmark, which was a couple percentage points below that. So a good structure that we expect over longer term is going to be continue to be a good diversifier and overall return generator for the portfolio. Let's flip forward one more page.
Let me ask you a quick question on that. So
Sure.
for the last one, the Redwood, are they, I know they're global, but are they global as in a certain part of the country? Are they focused on Asia? Are they focused on Brazil? Or are they the BRIC countries? What are they? What is their specialty?
Yeah, so I mean, Redwood's going to be I think they're going to be more of a diversified all-weather type manager. So no, I mean, we're not going to see a significant concentration in emerging markets. And I think that's sort of the case with all of those managers, and why we have, not only them, but Foresight, Martin, why we have them benchmarked to that all country world ex-US index, because that's really the entire global market. So which is sort of it's sort of a 60-40, think of it like a 60-40 market, 60% US, 40% non-US type market. And that's really, and again, it can encompass all, it can encompass the developed markets, the emerging markets, large cap, mid cap, small cap, growth, value. So it kind of covers everything. So all of these managers are going to do, a really good job. And again, this is where, Exponence and their expertise comes into play, because they are selecting managers that are going to be good offsets to each other. So they don't want all of these managers sort of doing the same thing. But I mean, in a nutshell, they're all very well, I think, diversified, all-weather type global managers.
Thank you.
And we can, and if you want to, we can at a future meeting can pull up exposure sheets from each of those managers and sort of show what the breakdowns of each of their portfolios are and what they look like, if that would be helpful.
I think it would, because they switched some managers from when they took the portfolio from Progress. They made some changes, but we really didn't do a deep dive into who the underlying managers were and the changes that they made, because it was so quick into to getting it implemented, because we were on a short time frame. So it would be good for us to know a little bit more about these managers.
Okay, so we'll put that on the list to have a discussion that just goes over more of the characteristics of each of those managers. And certainly as part of that, and if everybody would want to do that, we could also put as part of an educational session, could have Exponence on the list, and they can come in and talk about it as well, and maybe give a better overview of, here's how we selected each of these sub-advisors. This is what we're looking for. Again, this is how we're trying to create a full diversified portfolio, and this is how our structure comes together and works. So that would be another way to do it. So we can handle it whichever way the board wants. We can certainly come in and just share a few slides and show a few things, but certainly if everybody wanted to hear directly from Exponence on this and how they operate, we can also set that up as an educational session.
Yeah, so I defer to the educational committee to add to their agenda. I appreciate it.
Okay, great. So we'll follow up with Sue on that and just figure out what the best way to move forward. Okay, so fixed income, really quick. Again, positive across the board, so that's good. As we talked about that pause that the market has taken from the selling and coming back in and thinking about interest rates and a potential slowdown from the Fed. So certainly that's something that has worked out across the board for most fixed income strategies. And Gwilda did talk about before a little about the inflation hedge built in with some of the real estate managers in that area. we also have that allocation just shy of 2% to the TIPS fund. And you can see in the fixed income universe that was the best performer for the month of July. And again, while it is negative for that fiscal year period, it is the best performer. So, and again, I think that when we think about TIPS, people probably don't think them as being too similar to Treasury securities, but they are, in that when interest rates are going up, the values will go down, despite the fact that they're inflation hedging vehicles. They still are fixed income vehicles, and they're still susceptible to that interest rate risk, but they will perform better in this type of environment because everyone is buying them, because the coupons on those bonds reset along with inflation. So the higher inflation goes, the better that coupon keeps getting in the portfolio. So those have done well relative to other areas of the market. Now, again, to think about positives of this portfolio, because again, it's hard to think about a portfolio structure in this type of market that we've seen like this, that says, well, isn't fixed income supposed to be our diversifier and our downside risk protector and zig when the market zags? And it certainly should, and this has been a real challenging environment for it. A couple of things to point out: it definitely has been down less than the equity market, so there has been some capital protection there. And on a go-forward basis, to think about it, again, as interest rates have gone up for the majority of these strategies, these managers, the active managers, are going to be repositioning their portfolio. So now they're going to be out there buying bonds that now have higher coupons because interest rates have gone up, and now companies come out, and when they issue new bonds, they have to issue them with higher coupons. And so our active managers should be buying those higher coupon bonds. All of that going forward for the next, let's call it 12 to 18 months and beyond, as long as interest rates stay at the level that we're at right now, we're going to be getting a better coupon yield, so better return in fixed income from that portion of a fixed income securities return. So that, while it's short-term negative, it's medium to long-term positive for fixed income. So again, from the standpoint of how we're positioned and how we've restructured, we think this is a good place to be. And again, it's right-sized from a risk and a liquidity perspective. So let's flip forward one more page. And again, you can take a look at the PIMCO fund, which has had some good participation for the month in both the equity and fixed income markets. The Entrust position, again, we know that that's just one holding, and it's gonna price fairly erratically on a go-forward basis until that gets liquidated. Again, a very small position in the total portfolio. White Box had a bit of a rare miss for the quarter, but again, they've done a pretty good job navigating some pretty volatile markets and to stay solidly positive. And then Grosvenor with a nice month and not too far off the benchmark for the fiscal period, and have been protecting and adding some value over those longer terms. So again, not the total hedge funds, we're at about 7% of the portfolio. It's not the biggest piece of the portfolio, but it does, again, act as this nice downside governor in the markets and a good diversifier within the total portfolio. And then if we flip forward to the next page, and this is where I did want to talk a little bit about the monthly reports. And these monthly reports, they're great because they give us a general idea, in particular, of how the liquid markets have done and in the general direction that we're going in. But I also want to talk about the caveats of the monthly report, and that sometimes we just don't have a lot of information. So we have real estate managers that aren't reporting on a monthly basis. We know even with a lot of these lesser liquid real estate funds and private debt, private equity, that even on a quarterly basis, we're not getting great numbers. And that's why we always want to focus longer term out for a lot of those managers and not pay attention on a month-to-month basis. But I guess the good news on that is, if you had to dissect all of those pieces and come up with what a monthly return would be, it will be pretty good in this type of environment. So think about that top line return of the fund, and adding a little bit of return to that monthly figure, because a lot of those private strategies have actually had a pretty good run in this environment. So I'll pause. I know that's a lot to think about, but again, it's on the positive end, and it's good to see a month like July and getting a good tone back to the market. And so far so good. In August, we continue to see that trend as well. Okay, well, if there's no questions, that's all I have.
Thank you.
Are there
Thank you.
any other questions for Jeff and I regarding the performance? Next month, as I mentioned, TCW will be coming in to present. Or virtually, I should say, virtually.
Yeah.
Okay.
It'll be part educational, part
Yes,
performance.
part education, part performance.
Gwelda, the only question I have was the update status, if anything, on the MBEWB brokerage.
As I
Did we-
mentioned, we've had conversations with both Intech and TCW. TCW has committed to increasing there, and they actually have engaged Loop Capital. So you should start seeing Loop in there in the third quarter reporting and the fourth quarter reporting. So they've asked us to give us some time to engage and to put trading that way. Intech, we're not quite as confident about whether or not they're going to be able to do this because of the way that they trade. Albeit I did speak with a MWDBE brokerage manager, broker, excuse me, and they said they have traded with firms like Intech, or I should quantitative firms like Intech. So we'll see what happens, but they are with, I want to say the firm is Guzman, is who Intech, you see that 14% there. I can't remember, that may be the wrong name, but anyway, they are trading, but they're not up to the percentage, but they have not committed to increasing that. So I think that's going to be a harder sell, and that may be, and they were given probation letter as a result of them not meeting the MWDBE brokerage. They're engaging with, at least TCW is engaging with MWDBE brokers. That's the latest. So we'll look to see what the numbers start looking like.
So am I to read this correctly, that $909 is the commissions for TCW?
Yeah, year to date. They just started, but they just started with the MWDBE brokerage. Yeah.
Okay.
But we have been, we had the conversation with them. They've been notified that they are on probation due to this factor, and they have told us that they've told us they will comply. So it's just going to take, it may take a quarter or two for them to get up to that level, because they're now implementing all of their systems and trading with the MWDBE brokers. So I think just based on our conversations with them, we are confident that they'll get there. And again, they have told us that they can get there. And again, think of their strategy relative to Intech. So Intech is, it's a very systematic quantitative process, and there's a lot of different moving pieces that sort of make it more of a challenge. They can do it, but it's a little bit more challenging for them to implement. Whereas TCW, being more of a discretionary stock picker type of a manager, really should not be at all hard for them to get that up and running and get with the program. So.
Oh, and I do have a question. Some of the brokers have been contacting me directly, and they wanted to know if they can get a list of the managers and the contact people at the different managers. Am I at liberty to send those or have that sent out to them?
Gwelda, I'm guilty, right? I'm sending them to you.
That's fine, but I just need to know, can I give them those managers, our manager contacts? Absolutely.
Because I just don't have the time.
Okay,
And
that's
so
fine.
I wanted to run everything through you. And the larger the pool that we have to be able to give to our managers, the better.
Mhm. Okay.
So, yep, I don't think, I'm speaking for myself. If anybody else has any questions or comments on that, please, speak up. But what we're trying to do is add to the minority brokerage platform so that some of these managers have a variety, a larger pool to be able to execute these trades. But we're not telling them to trade with a specific broker.
Yeah.
We're just giving them the list so that they can select themselves.
Yeah. Well, I will direct them to the client service person that we have on, and then that client service person will probably direct them to their traders within their individual organizations. So I'll go ahead and start working on that.
So I'm at a car dealership, so I can't swipe to multiple screens. Do we have anything else on the agenda?
There's nothing else on the agenda.
Is there any questions from any members that we want to address? Hearing none, Gwilda, thank you, Jeff. Thank you, Gwilda, for your presentation today. Thank you, Sue. Hearing no other agenda items or comments, can I get a motion? Can I get a motion to adjourn?
I make a motion to adjourn the committee meeting for today.
Second.
It's been properly moved and second. All those in favor, please say aye.
Aye.
Aye. Thanks, everyone. Enjoy your weekend. I appreciate it.
Take care, everybody.
Okay. All right,
Thanks,
bye-bye.
Gwilda. Thank you.
Bye-bye.
Thank you all.
It was nice meeting you guys too at the
I
conference.
know, we finally got to see each other face to face. It was so good
I
to see
know.
all of you. All right, y'all take care. Enjoy the week.
Okay.
Okay.
All right,
Good night, everybody.
All right. Bye, everybody.
Bye.
All right.